During the second quarter, DSM Capital Partners LLC significantly increased its stake in Netflix Inc., Nasdaq, NFLX by 158%, now holding 83,175 shares valued at approximately $111.38 million, making Netflix the 19th largest position in its portfolio. Similarly, Fulcrum Capital LLC slightly increased its stake by 0.6%, totaling $15.33 million, and positioning Netflix as the 8th largest holding in its portfolio. Collectively, institutional investors own 80.93% of Netflix's stock, reflecting continued confidence in the company's future performance despite recent insider sales. Netflix's stock opened at $1,220.08, with a market capitalization of $518.45 billion and a price-to-earnings ratio of 51.98. The company reported strong quarterly earnings, with an earnings per share EPS of $7.19 and revenue of $11.08 billion, marking a 15.9% year-over-year growth. Despite recent analyst downgrades, the stock retains a consensus moderate buy rating with a target price of $1,337.63. Insider trading activity has attracted attention, particularly with CEO Theodore A. Saranda selling shares worth over $2.35 million and reducing his ownership by 11.78%, while Director Reed Hastings reduced his holdings by 99.07%. These sales have raised questions about insider confidence at current valuation levels. As Netflix continues to expand its global reach and content offerings, its financial performance and strategic initiatives remain under close scrutiny by investors and analysts. The company's strong net margin of 24.58% and return on equity of 42.50% underscore its financial health, supported by strategic content investments and a diversified portfolio across various genres and languages.
QUALCOMM Incorporated, Nasdaq, QCOM, has seen a notable increase in institutional investment, with Drucker Wealth 3.0 LLC increasing its stake by 29.4% in the second quarter, now holding shares valued at approximately $1.22 million. This move is part of a broader trend among large investors, with Kingstone Capital Partners, Texas LLC significantly expanding its position by an extraordinary 656,661%, now owning shares worth over $9.36 billion. Other major entities like Nuveen LLC, Goldman Sachs Group Inc., and Deutsche Bank AG have also increased their holdings, reflecting strong institutional confidence in Qualcomm's market position and future prospects. Despite these positive investment trends, Qualcomm's stock has faced some volatility, trading down 7.3% to $153.64. This comes amid insider selling activities, including transactions by the company's CEO and CFO, which may have influenced market sentiment. However, Qualcomm's recent earnings report showed a robust performance, with a quarterly EPS of $2.77, surpassing analyst expectations, and a 10.4% year-over-year revenue increase. Analysts maintain a moderate buy rating on the stock, with a consensus target price of $182.82, suggesting potential upside. The company's strategic focus on advancing wireless technologies through its Qualcomm CDMA technologies, technology licensing, and strategic initiatives segments continues to drive its growth trajectory, positioning it well in the competitive tech landscape.
The United States has finalized a $20 billion economic support package for Argentina, purchasing Argentine pesos as part of a broader strategy to stabilize the nation's turbulent financial situation. This initiative, announced by U.S. Treasury Secretary Scott Bessent, includes a currency swap framework with Argentina's central bank. The move comes as Argentina, led by right-wing President Javier Milei, grapples with market instability following a significant electoral defeat in Buenos Aires. The U.S. intervention is aimed at providing immediate liquidity to Argentina, with Bessent emphasizing the strategic importance of a stable Argentina for the Western Hemisphere. The support package has drawn mixed reactions, while IMF chief Kristalina Georgieva praised the U.S. action, aligning it with the IMF's $20 billion loan to Argentina. The plan has faced criticism from U.S. Democratic lawmakers. They argue that Argentina's recent suspension of soybean export taxes undermines American farmers. Despite this, Bessent has defended the initiative, highlighting its potential to stabilize Argentina and prevent a shift in political alignment in South America. The U.S. sees Argentina's economic success as crucial for regional stability and prosperity, suggesting that the country's reform agenda holds systemic importance.
UnitedHealth Group Incorporated, NYSE, UNH, has seen significant activity among institutional investors, with Williams & Novak LLC notably increasing its holdings by 114.4% during the second quarter. This move brings their total investment to 1,441 shares, valued at $450,000. This uptick in institutional investment comes amid a broader trend, as other entities like Bayforest Capital Limited and Clal Insurance Enterprises Holdings Limited have also significantly increased their stakes in UnitedHealth Group. Institutional ownership now stands at 87.86%, reflecting strong confidence in the healthcare conglomerate despite recent earnings results that fell short of expectations. UnitedHealth Group recently reported its quarterly earnings, revealing a revenue of $111.62 billion, slightly below consensus estimates of $111.75 billion. The company's earnings per share (EPS) were $4.08, missing the anticipated $4.45. Despite these figures, the company has shown a robust year-over-year revenue increase of 12.9%, although its net margin stands at 5.04%. Analysts maintain a mixed outlook with a consensus hold rating, but some have adjusted their price targets, signaling varying degrees of optimism about the company's growth prospects. The stock's performance remains a focal point for investors, with a current market cap of $320.88 billion and a dividend yield of 2.5%, indicating a stable, if cautious, investment environment.
Santander has announced the closure of 76 branches across the UK in 2025, reflecting a significant shift towards online banking as customer behavior evolves. This trend is not isolated to Santander, as other major banks like NatWest, Lloyds, and Halifax are also reducing their physical presence. The closures, including a prominent branch in Surrey Quays, London, are part of a broader strategy to balance investment between digital services and physical locations. The bank aims to enhance its digital offerings while maintaining a network of 349 branches and introducing innovative concepts like work cafes and community bankers to meet customer needs. The closures raise concerns about the accessibility of banking services, particularly for older and vulnerable customers who may rely on face-to-face interactions. While the bank is committed to minimizing the impact on customers, the shift underscores the ongoing transformation in the banking sector, driven by technological advancements and changing consumer preferences. This transition highlights a broader industry trend where financial institutions are increasingly prioritizing digital platforms to deliver services, which could lead to further consolidation of physical branches in the future.
Everdeen Group plc has increased its stake in NextEra Energy, Inc., NYSE NE, by 7.9% during the second quarter, according to its recent 13F filing with the SEC. The institutional investor now holds 2,522,547 shares, valued at approximately $175.1 million, representing about 0.12% of NextEra's total shares. This move is part of a broader trend where several hedge funds have adjusted their positions in the utility giant, with firms like Brighton Jones LLC and Revolve Wealth Partners LLC also boosting their holdings. Currently, institutional investors own 78.72% of NextEra Energy stock, reflecting strong interest from the financial community in this major player in the clean energy sector. NextEra Energy, a leading utility provider, has seen a series of analyst actions, with Barclays, JP Morgan Chase & Company, and BMO Capital Markets raising their price targets on the stock. The company reported a quarterly earnings per share (EPS) of $1.05, surpassing the consensus estimate of $1.01, and a 10.4% year-over-year revenue increase to $6.70 billion. Despite these positive financial indicators, the company's revenue fell short of analysts' expectations of $7.52 billion. NextEra's stock is currently trading at $83.30, with a market capitalization of $171.54 billion, and maintains a moderate buy rating from analysts, with an average price target of $85.08. The strategic moves by Aberdeen Group and other institutional investors, along with favorable analyst ratings, suggest a positive outlook for NextEra Energy. The company's focus on clean energy solutions, including wind, solar, and battery storage projects, aligns with the growing demand for sustainable energy sources. However, the mixed earnings results and ongoing insider stock sales highlight potential challenges and market volatility. Investors will likely continue to monitor NextEra's financial performance and strategic initiatives closely, particularly in the context of evolving energy policies and market dynamics.
DHL e-commerce CEO Pablo Ciano has underscored the strategic importance of India in DHL's global growth ambitions, highlighting Blue Dart's pivotal role in this trajectory. Blue Dart, DHL Group's express logistics arm in India, is stepping up its operations through a comprehensive, multi-year investment plan focusing on expansion and digital transformation. This investment aligns with India's status as one of the fastest-growing economies, presenting significant opportunities for logistics and e-commerce growth, which DHL aims to capitalize on. The emphasis on India comes amid a broader context of global logistics companies seeking to tap into emerging markets to drive growth. As Blue Dart scales up, this move is expected to enhance DHL's competitive positioning in the region, potentially boosting its market share in the burgeoning Indian logistics sector. This expansion is likely to have a positive impact on DHL's overall revenue growth and could influence market sentiment positively as investors look for stable returns in emerging markets.
Zero Knowledge Proof, ZKP, is introducing a transformative approach to the crypto market by focusing on rewarding participants for their ability to verify and validate information rather than merely accumulating tokens. Unlike traditional crypto ecosystems that prioritize wealth accumulation, ZKP emphasizes credibility and integrity, encouraging users to engage in fact-checking and validation. This shift addresses the growing need for trust and accountability in a market often plagued by speculation and misinformation. By implementing a system that values knowledge and verification, ZKP aims to create a more sustainable and credible blockchain environment. The upcoming whitelist for ZKP is structured to attract individuals who contribute to the protocol's integrity rather than those who merely have financial power. This approach contrasts with typical crypto presales that often focus on generating hype and rapid capital accumulation. Instead, ZKP seeks to build a community of thoughtful curators who prioritize insight and credibility over short-term gains. As the crypto industry faces challenges related to trust and transparency, ZKP's model offers a potential blueprint for fostering a more reliable and knowledge-driven ecosystem, potentially setting new standards for future crypto projects.
During the second quarter, several institutional investors, including KFA Private Wealth Group LLC, SLT Holdings LLC, and Trust Company of Toledo NAO, have significantly increased their holdings in the Vanguard FTSE Developed Markets ETF, NYSEARCA, VEA. Specifically, KFA Private Wealth Group LLC boosted its investment by 21.8% to 12,057 shares, valued at $687,000. SLT Holdings LLC acquired 5,086 shares worth $290,000, and Trust Company of Toledo NAO purchased 37,065 shares valued at approximately $2.1 million. This ETF is designed to track a market cap-weighted index comprising large, mid, and small cap stocks from developed markets outside the United States, providing broad exposure to international equities. The ETF, which has a market cap of $176.33 billion, recently experienced a 1.9% decline in its trading price to $59.18. It features a price-to-earnings (PE) ratio of 16.34 and a beta of 0.89, indicating moderate volatility compared to the broader market. Despite the recent price dip, The ETF's performance is underscored by its 50-day moving average of $59.22 and 200-day moving average of $55.95, with a one-year low of $45.14 and a high of $61.32. The increased interest from institutional investors reflects a growing confidence in international markets, driven by the diversification benefits and growth opportunities available outside the U.S. These investments in the ETF suggest a strategic approach to mitigating domestic market volatility while leveraging favorable conditions in developed economies globally. Investors and analysts are closely monitoring these trends to assess their impact on the ETF's performance and the broader market dynamics.
Bank of America, NYSE, BAC, has seen a notable increase in institutional investor interest, as evidenced by KFA Private Wealth Group LLC's recent acquisition of 4,777 shares, valued at approximately $226,000 during the second quarter. This move is part of a broader trend, with several institutional investors, including Wealth Advisory Solutions LLC and Syndio Wealth Partners LLC, increasing their stakes in the financial services provider. This heightened activity reflects continued confidence in Bank of America's performance and potential for growth, particularly in light of its recent earnings report, which exceeded analysts' expectations with an EPS of 89 cents compared to the consensus estimate of 86 cents. Bank of America has also announced a significant $40 billion share buyback program, signaling management's belief that the stock is currently undervalued. Such buyback programs can bolster stock prices by reducing the number of shares available on the market, potentially increasing earnings per share. Alongside this, the bank has increased its quarterly dividend from 26 cents to 28 cents, offering a yield of 2.3% and a payout ratio of 32.75%. Analysts have generally responded positively, with Morgan Stanley and others raising their price targets, reflecting optimism about the bank's strategic direction and financial health. Overall, these developments suggest a robust outlook for Bank of America, with potential implications for its stock price and investor returns.